Leverage, leverage, leverage. What is it? And how can a real estate investor use it to their advantage? Can you really turn one property into many using this powerful tool? How many times have you heard investors talking about the importance of leverage? The concept of leverage in real estate investing is one that can seem intimidating at a first glance, but it's actually quite simple. In this video, we'll explore the basics of leverage and how it can help you build your portfolio faster than ever before. And hopefully by the end of this, you can be well on your way to learning how to treat property like a business. And if you haven't already, make sure you click on the follow button below and also let me know your problems in the comments you have on your journey and I'll create a video for you. How much effort will you put in? What are you willing to do to get there will determine how far you go. A little bit about me. I'm Scott Levoune. I'm the founder of Wealth Through Property. I started investing in property at the age of 30 years old while working a full-time job as a tradie. I wasn't on a big income, and within the space of 3 years with the right mentors, I was able to build a system where I was able to retire with over 10 properties and over 100,000 in passive income. So let's dive in. What is leverage and how can it help us as a real estate investor? Let's do the apple tree analogy. Let's imagine you plant an apple tree and you water for a few years. You may be able to get a handful of apples from that tree. Depending on how well it grows, you have the choice. You can either eat all the apples from that tree or you can take a few, plant them and hope they grow into more trees. You don't want to use all the apples from the one tree, but you would be happy to use a few to get more trees. This is the same concept that any real estate investor uses when it comes to leveraging their investments. Investment properties can produce two things. One is rental income and the second is capital growth. There are also a few ways you can leverage a property. Let's look at buying your first property. It's a principal place of residence. You buy the home to live in and you've just purchased it. The property isn't going to go instantly up in value and you're not going to instantly pay off the mortgage. So how do we leverage our first property to get more? How do we even get the first? We leverage the bank's money to buy our first property. When you buy a property, you're going to need to get a loan. So you're going to need to go to a bank and a lender and they'll give you the money to buy one property, but all of the money for this purchase. Remember this, banks work on risk and liability. A bank is going to ask you to meet a certain criteria for the money to be lent. Usually this means you need to have some sort of deposit saved as well as be able to show your income and be able to pay off the loan. And so you're not going to get 100% of the loan to buy a property because banks won't do that. It's just too high risk for them. So the banks are going to ask for a 20% deposit for the property value. Let's be clear. A bank might lend you at a lower LVR, which is a loan to value ratio, though they are generally going to give you a high interest rate and add on their insurance to cover their risk. This is called LMI, Lender's Mortgage Insurance. So we have our first loan and have put a 20% deposit down. We have already leveraged the bank's money to buy our first property. But how do we move forwards to buy our next? We understand that banks don't like to go over the 20%. So how do we go to our next one? There are two ways to get equity in your property, which can be used to borrow more money. The first way would be to pay off your loan over time and reduce your LVR. This will take time until you have enough equity to be able to buy more. The second way would be through capital growth, where the value of your property has increased and can now leverage that equity from the first property to buy a new one. Most people do a mix of both. Pay down the loan and use capital growth. As your loan starts to drop under 80%, we refer to this as usable equity. What is usable equity and how can we use it as our investment property? Usable equity is the amount of equity you have in your property that can be accessed to either buy more properties or take out the property for other uses. Not all your equity is usable, and it only becomes usable when you have reached a certain stage of your loan to value ratio. Remember, your banks like to keep a lower LVR ratio, so they will generally want to see you below the 80% when you can start accessing that equity. If your loan amount drops to 70% from 80%, you can access only the 10% of the equity and not the 30%. I'm going to make it clear, just because you have usable equity, it doesn't mean the banks will let you take it out. It also doesn't mean you can take it out or you have the capacity to buy more property with it. You want to make sure your bank or your mortgage broker has checked you have the capacity to buy another property. Let's assume your bank or mortgage broker has given you the go-ahead. There are three ways to access this money. The first is to refinance to another bank. The second is to do a top-up loan with the same bank. And the third is to cross-collateralize. A top-up with the same bank is usually at a lower rate, so you can use the equity to leverage more than one property. This means the bank you're already with will let you borrow more on your current property and use that equity to pay for the deposit for your next property. When you refinance, there are usually costs to go with the whole new loan and sometimes even have two loans on the same property. A refinance is a complete new application, whether it's with the same bank or a different one. There will be more costs involved with the refinance, so it's important to check the final cost before going through this process. The third option I want to get into is cross-collateralization. This is where the banks will allow you to use the equity from one property to buy another property without actually taking out any money. They would normally use your first property as security for the second one. In our opinion, this is a dangerous way to lend money. This is because if you lose one property, the bank can go after both. This means you could buy the second property at 106% debt without the need of another deposit. Why I don't like cross-collateralization, apart from the banks being able to take one of your properties so easily, whenever you go to refinance your property, because you have the security of the other property, the banks will always take both properties into account. If one property were to grow while the other was to drop, they may stop you from being able to take out the equity of the property that has grown altogether, stopping you from leveraging either property. This can slow down your property portfolio growth. Remember, banks work of liability and risk. Even if you were to service and both properties were to grow in value, we get to the point you have usable equity, it doesn't necessarily mean your bank would let you access the money. Also, a bank is is going to do everything they can do to reduce its risk and try to use your other properties as security in the event you can't pay the loan. Let's deep dive a little into leverage. It's like a battle between shares versus property. We know a property grows at 7% per year, but a share grows at an average of 10% per year. So immediately a share looks better. But think about it. Property has all the costs with rents, rates, repairs, and maintenance. Shares have very little costs apart from maybe the dividends or maintenance fees or management fees. So shares looks like the better option, correct? Imagine you invest in both these options using 100,000. Remember, the property will grow at 7% per year and your shares grow at 10%. After 1 year, the share is now at 110,000. But where is the property? If you're using the $100,000 for a deposit, you're not buying a $100,000 property. In fact, you're probably buying a $500,000 property. So your 7% growth is not on the deposit amount of the 100,000, but your growth is on the $500,000 property. Your share portfolio is now 110,000, whereas your property is now at 535,000. Even though shares grew at 10%, you can see because of the leveraging of the property, you would have earned more money. Not just that, once the property grows at a certain amount, you'd be able to leverage the capital from the property to buy another property. This would double your scenario within the property. Remember, it's not about the loan or the deposit, but the amount of the property values. If you were to wait 10 to 12 years from the point of acquiring the second property, there is a chance they have both doubled in value, and you could sell the property to keep the property outright. As you can tell, the property is a far superior way to grow wealth over time. Most people who don't like property or have gone bad in investing in property are the people who have done a journey by themselves and have bought dud properties. I hope you understand the power of leveraging and the risks that come with it. I really hope you've enjoyed this guide on how to start when looking to build your team and start your property journey. Please follow, like, share, and comment if you got any value, and stay tuned for more.